Welcome to a special edition of Modern Wall Street here from the Nasdaq MarketSite in New York. Today I'm joined by Joshua Siegel, who's the Chairman and CEO of StoneCastle Financial Corporation. Josh, great to have you here today.
Thank you.
Well, in the current regulatory environment, focus has been on the regulatory rules that are taking place in Washington, D.C. But at the same time, the Fed stress test results came out last week, and we know the impact it had on the banks. So when it comes to the community banks, tell me what's happening right now.
Well, community banks tend to be overlooked. They're very long-standing institutions. They've been around actually quite a bit longer than most larger banks, surprisingly, over 80 years on average. Their financial health is the best it's been in over a decade. Their profitability has been improving according to the FDIC. Their non-performing loans are the lowest in a decade. So the function they've served, really bringing credit to small communities around the country and have for decades, continues. Just because so few are publicly traded, you don't tend to see it as much as you do in the largest banks. So their world continues. Profitability is not as high as it was before a lot of the regulatory changes pre-crisis, but their profitability is still a little over 9% return on equity, so it's quite strong.
And speaking of equity, the equity markets have been paying attention to the Fed stress tests.
Yes.
Now, the big banks were cleared last week, and we saw a rally in the financial sector. But when it comes to the community banks, you're called on by government agencies to consult on issues that affect them. So going forward, what do you expect to see in terms of near-term trends?
Well, when you look at the largest banks, the need for stress tests, which really was around even before we called them stress tests, the complexity of their international operations, their systematic connection to global payment markets, as we all sort of very realistically saw during the crisis, the concern at the Treasury and Fed level for the systematic sort of spiraling of what could occur. Community banks, they don't tend to have those operations. They don't have derivatives. They don't really have international operations. They don't have capital markets. And so the regulatory construct around what they do tends to be more consumer focused. It tends to be more lending focused, traditional lending focused. And so the focus really there when it comes to Financial Choice Act or other issues that are being discussed in Washington is to try to remove as much of the burden from day-to-day operations for these small banks so that it allows them to put more credit back into the markets and sort of take less people offline for, lack of a better word, paper pushing, rather than doing one of the two most important things, which is either finding new customers for the bank or better managing the risks, the credit of the bank. So the short term for them is, right now in the forecast line, is more profitability. Interest rate sensitivity is a big issue right now. Banks are unique generally, so whether you're a large bank or a small bank, as interest rates go up, profitability goes up. Most corporations, it goes the other way. Rates go up, profitability goes down. Sure. So that's what we're seeing in sort of the right here and right now, is increasing profitability because interest rates are moving up.
And StoneCastle Financial Corporation is here today to ring the closing bell at the Nasdaq MarketSite. Now, the company is listed on the Nasdaq Global Select Market under ticker symbol BANX. So tell me a little bit about your company's business model as well as performance year to date.
Sure. So StoneCastle Financial is really the first public arm, the retail arm that we've launched at StoneCastle Partners. We've been around since 2003. We manage about $13 billion of assets in total. So StoneCastle Financial is the first component of that the average investor can invest in.
Sure.
Our whole focus is we touch about 800 different community banks in all 50 states, Guam and Puerto Rico, truly everywhere. And we try to bring credit to these banks as well as funding to these banks, really to help bring credit to these smaller markets around the country. I mean, you have something on the order of 900 counties in America. About a third of American counties are only served by a community bank. Mm-hmm. And so if you want to have small business growth or credit for the farmers or literally the things that make everyday business work, you need those community banks. Mm-hmm. And so that's been our mission. There's what we call the multiplier effect. Mm-hmm. When we put $1 million of capital into a bank, it allows them to make 10 million of loans. So what we've put into these banks over the years has allowed these banks to put billions of dollars of credit to work in these markets. And so we were the first, and I think still are the only publicly traded company that gives investors an exposure to these very healthy, long-standing community banks. And we pay a dividend rate of about 7.5%, where the average community bank dividend rate is about 2.5% to 3%. So it's a very good rate of return. I think this year it's about a 13% total rate of return for 6 months of the year on public data. So it's been a great mission. It's been a great position because there really is no competitor close to us, and the rate of returns have been fantastic.
And Josh, last but not least, before I let you go, we do live in very interesting times. We continue to see interesting breaking news reports out from Washington, D.C. But when it comes to regulations for the financial sector, we are keeping an eye on the Choice Act as well as the Clear Relief Act. So when it comes to community banks, what are the implications?
Well, the implications for the smaller banks, for example, the Volcker rule, not an issue for small banks. They don't have proprietary investment arms. A lot of the Consumer Financial Protection Bureau issues geared toward, for example, consumer credit cards, not a large area for small banks. Most of what they do are small business loans and real estate loans. That's really what they tend to do, both commercial and residential. So things that would change Fannie and Freddie, those issues will be affected for the small banks, allowing them to be able to be probably more competitive in the mortgage space for homeowners. I think you'll see probably more profitability with less personnel doing regulatory filings that don't change the credit profile or safety and soundness. So I think some of the areas in the Choice Act will help in that realm. I think that there will be some standardization. There's clearly a provision in Choice that if a bank wants to keep a 10% leverage ratio, just to keep it simplified, 10% capital, they can be exempt from a whole range of rules. And it's not that the exemption is going to change the risk profile. It just allows them to get more personnel, an average 99 employees for a community bank in the country, more of them either putting credit to work or managing the risk they have, and less people doing a filing for example, a vendor review, where they say, okay, every bank has to do an outside review of every single vendor, even though that vendor may work for 1,000 different community banks. It's just the repetition in the space. So what came after the crisis was a whole range of new rules, of which there were some very good ones to protect consumers, but there were also just a lot that were busy work. It's not actually changing anything other than adding cost to the system. And if those costs come out, the cost to consumers can come down. That's better for the economy.
Well, Josh, it's not every day that we tend to focus on community banks, so thank you so much for your insight today, and good luck with the closing bell.
Thank you.
Thank you.